Let's talk a bit about your portfolio in that case. So we've mentioned a few names so far for those who are listening to the long version of this, but those who aren't, you'll find out soon enough. If you tell us sort of in broad strokes for the moment, then how does your kind of portfolio break down in terms of, well, however, whatever categories you fit things into? They might be
Cool.
stocks or bonds or US stocks or UK stocks or whatever. How do you kind of characterize that in sort of broad terms?
Cool. Yeah, sure. So I'm actually out of bonds at the moment. I wouldn't touch the long end of the yield. I just think there's so much risk, especially in US 30 years and things like this. Really wouldn't touch it with a barge pole right now. Short debt, maybe. I don't know. It's something I'd consider, and maybe I should spend a bit more time looking at. I moved to a lot of cash, 42% cash. I think I just had a little look before. This does include my pension, which is obviously less. It's more passive, so it's more invested than the rest of my portfolio. So I have moved to a lot of cash at the moment, and I'm about 50 in terms of my invested portfolio. It's about 50-50 split between North American equities or North American listed equity or US liquid equities and UK listed equities. For my sins, I'm totally out of Europe at this moment in time, but that's probably because I had a few European companies that did rather well. So yeah, I'm kind of it's a less bullish portfolio than it's been for a long time. Major players, funnily enough, one of them, the largest player actually by a long way now is Jet2, one that I stocked up on. I bought it just before Liberation Day and then kept topping up after Liberation Day. And I think we're up about, from the nadir, from the bottom, we're up about 68%. And that was I've been much more targeted this year just because I'm not entirely sure where the value is. But yeah, the traditional US stocks are there. I still got Nvidia. I topped up when it fell to about $85-$90 recently. Made a few small investments during that kind of choppy April, including Alphabet, which is Google, and Pinterest. But the rest of my portfolio, and maybe it's time for a bit of rotation because I have the Barclays and Lloyds, which are they both doubled in value pretty much over the last year for me. Rolls-Royce was very much the same. In fact, the four main UK stocks that are in my portfolio were doubled in value last year. And the other one being IAG, which I've now left my position, my holdings in IAG just because of the volatility. I don't know how closely I don't know if you watch IAG yourself, but we were up to 320, and I think we fell close to 230, and then we're up to 330 again. And yeah, it just there's a lot going on there, and a lot can change, obviously, depending on trade policy. So yeah, that's broadly where I am at the moment. I think I'm looking for opportunities, potentially accepting that there might be some pullback soon. I think there probably should be pullback soon, partially because of what I said before about the position we're in the macroeconomic terms. It just doesn't add up to a really hot market. And I'm also being more cautious about US investments in general, just because obviously I don't have today's figures, but I think the pound's about 135 to the dollar. About 6-8 weeks ago, we were closer to like 131, 132. So we're having some quite big swings, and of course that price appreciation can really wipe out any appreciation that you make on the stock itself. Which I think is really important. A lot of investors need to know. And Morgan Stanley, last week, I think it must have been, suggested that the pound could reach 151 against the dollar in its most optimistic scenario towards the second half of next year. It's a long way away, but what you don't want to do is, invest in a stock hoping for 10 to 15% growth, only to find that the pound appreciates by 10-15% and wipes out all those dollar gains.
Yeah, I feel that on the foreign exchange thing, not so much from pound to dollar, actually, and I really should pay more attention to that. But I do remember there being a time not so long ago that everyone was piling into, or not everyone, a lot of people were piling into Airtel Africa
Yeah.
And the Nigerian naira collapsed, which is a more volatile currency. And suddenly, all the people who had been experts on vaccines during the pandemic were now experts on the Nigerian naira, and were like, "Yeah, these things sort themselves out over time." I'm like, do they? I don't know anything
Really?
about
Yeah.
Nigerian currency exchanges. Good for you if
Yeah.
you do, but I strongly suspect you're making this up. IAG, by
Yeah.
the way, I absolutely detest as a stock for two reasons.
Oh, really?
One is it's an airline, and I don't really love airlines. But the bigger reason, the reason I don't like that, I prefer Jet2, to be honest. But the reason I dislike IAG so strongly is that if anyone looks on stock commendation, and I guess I probably recommend that you do to see what James is doing. If you look at my worst pick, I'm pretty sure it's avoid IAG
Ah,
somewhere fairly recently because I have systematically underestimated this cyclical upswing thing for the last couple of years or so, basically. So I haven't been on the wrong end of that, and I've been short the thing, but
yeah.
it is
Stock
cost.
commendation can get things wrong there. You never know. It might have been misappropriated to you
It
yourself.
might be. I don't love the stock. I mean, I did mean to say avoid it, and before that, my worst pick
Yeah.
was avoid Aston Martin, which I'm still sticking by. To
Yeah.
be honest,
Yeah.
I don't care that the share price is proving
Hard
me
to see
wrong
how
on
it
this.
can get itself out of there. Yeah, absolutely.
When you think about your portfolio, you mentioned your pension, and you
Mm.
mentioned your kind of cash waiting in not your pension, basically, and that's passively. How do you think about your portfolio? Because here's an interesting thing about, I guess, you as an investor.
Yeah.
You, unlike me, and to some extent, unlike Steve, have a largish in terms of ownership stake anyway, position in what we might call a wholly owned business, if we're talking all Berkshire Hathaway about it, right?
Yeah.
Does that factor into how you invest at all? Do you think to yourself, well, I own a drinks company, so I should diversify away from drinks companies, or I want to own more
That's
drinks companies because I think they're great, or anything like that?
it's a good point. So I think on the fact on drinks companies, yeah, maybe more subconsciously. I don't think I've actually given it too much thought in the past. I obviously remember when Celsius, and I actually don't know how Celsius is doing at the moment, but when Celsius became quite big news, I think probably about a year ago.
Yeah,
And I
horribly
was
since
looking at
then, I think. But
yeah, and I was looking at the multiples and the earnings projections and things, just thinking, do you guys know what the margins are like in soft drinks? Is the yeah, it's quite incredible. It's so that was that was quite interesting for me because hey, God knows CMAC was never going to be worth. So I've got a can here. That's why I keep kind of pointing towards it. CMAC will never be worth you know 40, 50 billion and trade at I think 70 something. I seem to remember trading at about 70 times forward earnings.
not at that
Um,
attitude, it won't.
yeah, well, yeah, exactly. I could change my thought, get a bit more on social medias and stuff, but it's yeah, it's interesting. So I obviously avoided that because I definitely I had some hesitancy. I know the industry a little bit, in specifically with regards to soft drinks, even with people moving away from booze, perhaps still it's a hard sell, and it's a really competitive industry. If I go to the factory where we produce this, there's loads of people, just people like myself who are going, oh, I really fancied making something which has enough as much protein in as two egg whites. I seem to remember the last time I popped somewhere. The guy's got no one to sell it to or anything, but he's just made this drink, and you never know. Maybe one day that could be the thing that takes off. It's a massively competitive industry, and that would put me off in some respects. At least buying a company like Celsius. I guess that's going to be the only competitor I know to Sumac, and not bad call ourselves a competitor, considering we're about 25,000 cans production and they're about 25 million a month. But I guess it makes me think twice about stocks in retail or certain aspects of retail, grocery retail, or things like this. Yeah, Diageo as well. Yeah, you kind of, I guess you kind of have some understanding for the way brands work and how things go in and out of fashion, and how you constantly need to be topping up that brand portfolio in order to retain some degree of. It's a very fast moving retail world, and one thing can be kind of super cool one day and then it's gone the next. Trip, and the great company makes those CBD soft drinks. Hey, that's gone from strength to strength to strength. I believe it contains more CBD than the the regulator recommends in the UK. There's probably a lot of things that people don't really want to accept about CBD that might not be that good for you. It slows your swimmers down, slows your sperm count. Lots of little things like that might kind of eventually catch up on it, and all of a sudden it only takes one big news story, and then all of a sudden it's not so cool anymore. So, sorry, what I'm saying in a very roundabout way is sometimes the stickability of these companies, is changeable. And maybe being in the industry has kind of pushed me away from investing in soft drinks, but it's an interesting one. It's not something I thought about too much, actually.
How do you think about diversification there, or do you think about diversification? I mean, I know you have to because you're a Fulbrighter, so you can't ignore the topic entirely, right? Even in your own kind of investing. But is it something you kind of deliberately aim for, or do you just kind of let it happen organically?
It's a bit of both. Yeah, so I do aim for it, at least geographically, definitely. And I say at this moment in time, it's possibly less diversified than it has been, but that's because I've been, selling stocks in certain, just in certain industries when they've got to valuations which I think are fair or above where they should be. So my portfolio has kind of organically become less diversified. It is still quite heavily focused on growth. When you look at names like Rolls-Royce, Celestica, Pinterest, Nvidia, Sterling Infrastructure, Powell Industries, Credo Technologies, these are still kind of very kind of AI-weighted investments. And it's not quite accounted for by the Jet2s, the Lloyds, Barclays, and kind of similar companies of this world. So diversification is super important. And I think if I was building out my portfolio again, and I think I will hope, I have a thesis, which is we are going to get some pullback in the market. And that's when I will start building in some more diversification. I'm pretty low on pharma at the moment. I think I've got a bit of AstraZeneca in my pension, and I've got still a very heavily focused growth stock, CRISPR Therapeutics, as well in my ISA. So there is some natural diversification there, but maybe not as much as I'd hope or kind of aim for when building the portfolio out again.
I wonder whether there's more to it than you think there. I mean, I remember someone saying at the Berkshire meeting a couple of years ago, how did Buffett and Munger feel about the fact that Apple's, 50-something% of their business? And Buffett said, and I think he's right about everything, but he's definitely right about this, in fairness to him. It's not 50 or 40 whatever percent of our business. It's 40% of our stock portfolio. Our business includes railroads and insurance companies and utilities businesses. And okay, we own those things outright. But that doesn't mean they're not ours in some way, right? So when you're thinking about those things, and that's kind of how I think for you a little bit, of you have, in terms of your asset base at least, a railroader-like thing, which is a soft drinks company here. So when you worry about getting overweight in your ISA or whatever, I mean, there's a big picture to kind of fit in around that.
That's very true. And I think, it was only recently I started actually putting together a spreadsheet every month whereby I put our ISA, as a family, I put the value of our ISAs, and I put the value of other things that we might own, and also like the house, the value of the house ex the mortgage. That is part of our diversified portfolio. Many people, and they've done quite well out of it. And they've built a life out of investing in bricks and mortar and renting it out to the next person who has to pay what they say is going to, or whatever, they're landlords. That's how they do things. So it's diversification, and as you say, it's not just what's inside your stocks and shares portfolio.